Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They're for information only. We start here with the weekly chart of the S&P 500. So each one of these candlesticks is a week's trading. This shows about the last 6 years. You can see the bull market that we've been on here for about a year. We really had a sideways period, a bear market through 22, and kind of a sideways for 22 and 23, and now 24 has just been absolutely off to the races, despite the fact that everybody was calling for recession problems, whatever it was. And sure, that may unfold at some point, but that is not what we're seeing at the moment here. It's just a bull market by any stretch. If we come down here to our daily chart, we see in a little more detail. This will give us the last 2 years trading and highlighted the trend line that we have going in our bull market here, and also some major support that we have below the market. As you can see, we had in October busted out above it, came back and kind of retested that level, and it was successful and off to the races. So all of our long-term indicators, the weekly chart, the daily chart, those are all pointing up. So really, really difficult to be arguing with this market at the moment. Come down here into a little more detail. This is a 2-hour chart, and it'll give us about the last 6 months trading. Gives us a nice idea of the trend going up. And as you can see, markets will get into a bad week or two and kind of retest levels. It's not just a straight up proposition, but as you can see, we've been just holding this trend and going higher. If we look at some of the internals in the market, with the story under the story, this is the percentage of the S&P 500 that is in an uptrend. Right now, it's sitting at 63%. As you can see here, back in October, it's at 80%. This is a little concerning because you basically have 2/3 of the market is in an uptrend, the rest is not, but you are right at all-time highs. So usually you'd want to see this up around 90. Otherwise, the situation that you may have, as we've seen in the markets recently, is just a couple of stocks, NVIDIA, Google, Apple, those sort of things. They're holding the market up, and they they're basically making up 20% of the market, seven stocks, actually a little more than 20%. So they can hold the index up, even though it's just those stocks, and the rest of them are having trouble, which is a bit of a sign of warning. And that's kind of what I'm seeing here. It's not terrible, but that could be something to watch. The next line down is the advanced decline line on the New York Stock Exchange. This another number of advancing shares over declining shares, and it's really been flat even as we've gone through this rally. It's just kind of flat. So again, I think what we're seeing is, yes, a handful of really great tech stocks are holding the market up. And it doesn't mean it's going to stop, but it is something to be aware of, that it's not just every stock in the market is holding this up. Then finally, at the bottom here, we have the VIX, the volatility index, and this is the price that people are willing to pay for insurance on their portfolios in the options market to protect their portfolios. Right now, it's pretty low. It's down, 13. We can see there, so it's definitely quite low. So the only concern I'm seeing is, again, we're only talking a smaller number of stocks that are holding up the market, so something to be aware of. We go over here to the this is the interest rate on the 10-year U.S. Treasury, and again, you can see here for the last 3 years we've just been right in this 4% range. It's really just held up. Been in back and forth, got up to about 5. We've been down to 3.5, but it's stayed right in that 4% range. So nothing really happening there. And it was that rise as the Federal Reserve started to kick rates up to control inflation in 22. That's what really caused the bear market that we had. But meanwhile, we've had some very, very stable interest rates, I'd call it, in the last couple of years. So as long as that remains, then maybe that's a positive for the market. We come over here to our economic indicators. GDP growth rate, we're at 2.8, last reading 3. So those are solid, having around 2.8 and 3. Unemployment rate around 4. That's nothing bad there. We did have some weakness in our last update that we showed here, that there were very low numbers in the most recent job numbers. But the most recent one that we got here, this 227, that's good. It's not great. But payrolls are solid, so we're not really seeing huge layoffs or anything like that. Lots of pundits might say, "Hey, it's coming," but it's not here yet. And until it does, it's hard for us to really react to it. We'd just be arguing with the markets. Inflation here holding in the mid 2s, solid. Not a real problem. If this were much higher, if this were up at 5, 6, we would definitely see interest rates moving higher to control that. As the Fed, it would become less likely that the Fed's going to cut rates or at least leave them alone. And then finally, retail sales, again, positive. It's one thing I look at, how people are they spending money? They're positive. They're not great. These certainly aren't great numbers, but they're still solid. And so it's hard to argue again with the market if everything's solid and not really seeing anything to concern yourself with. As far as earnings estimates going forward on the here on the S&P 500, this shows analysts' estimates of earnings going forward out to last quarter of 25, so a year from now, still showing solid. So basically, analysts are saying, yeah, earnings are going to be great on S&P. That's going to continue. That's a plus. And in recent months, I had certainly highlighted this, and this is my biggest concern: is we definitely have an overvalued stock market. If we look at just even a 20 times multiple, 20 times earnings for a valuation, it's how things are going to look at what's a multiple, a fair multiple in history of the market, and I'd say 20 is probably around that. It depends on where interest rates are, but 20 is fair. That would have us at 4,000, and right now the S&P is trading at 6,073. That's a little scary. We are in an overvalued market for sure. The earnings are there. The economic background is there, but this is an overvalued market, so it's something to be concerned about. But for the time being, if we go back here and look at the big picture, we are in an uptrend on whatever chart you want to look at, and whatever economic picture you want to look at. It's all in an uptrend. Certainly it could change, and we'll be watching very closely and making adjustments accordingly. But for now, there is no reason or nothing that we're seeing that's saying time to bail out. Even though as it gets further away, we could see this return to trend, have a couple of week pullback. That's certainly going to happen. As we showed here on the 2-hour chart, you're going to get these periods where you have for a week or two, they're going to pull back to trend, but nothing's showing that the trend is changing anytime soon. So I hope this was helpful and informative. I'm going to put up our contact information here. If there's anything you'd like to hear about in future videos, or if you'd like to hear about what we're doing in our portfolios for our clients, please don't hesitate to reach out. Otherwise, hope you have a very safe, healthy holiday, and we'll see you at the next update. And thanks so much for watching.